Gentlemen, I want to thank you all three for coming here today. We appreciate it. And I'm going to ask you if you would make opening statements, if you could hold your remarks to 5 minutes. As you can see, we are a lively panel with many questions and flights back late tonight. So I'm going to ask to hold your remarks to 5 minutes, but your entire written remark will be part of the record. Mr. Bienenstock, could I start with you, please?
Yes. Good morning, Chair Warren and panel members, Deputy Chair Silvers, Mr. McWater, and Dr. Trotsky. Thank you for the opportunity to testify today. Since I've heard several times that the testimony is automatically in the record, I thought, at least in part, I would try to supplement what I've written by crystallizing some of what I've heard this morning and tying it to the relevant portions of my written testimony. First, I have no issue with the emergency action taken by the Fed to provide the $85 billion facility on September 15, 2008. And you have more information than I do, but all I can say is from what I've been able to read from a layperson in the public, based on the speed of the meltdown and the exigencies of the situation on the heels of the unrescued Lehman bankruptcy and collapse, I don't know of any alternative. Whether there could have been some money from the private sector, I'm not sure at the end of the day will even make a big difference, because the $85 billion facility was all secured. So the secured part will be paid back. Hopefully it's oversecured and the government will get all its money back at a profit, but it was secured with everything AIG had of value as far as I can tell. Where I might take issue with some of what has gone before, both this morning and in prior hearings, is the notion that everything was set in stone on September 15. And let me backtrack for just a moment. The speed and suddenness of the need for the $85 billion facility, while I can tell it's surprising to many, including some in this room, is not surprising to those of us who have been through crises involving trading companies before. I met with Enron the Friday after Thanksgiving in 2001, and the next week it filed Chapter 11. When you're dealing with a trading company, financial statements and balance sheets changes the assets and liabilities. It also changes the risk profile. When the market loses confidence in either the trader or there's a pervasive market shift in confidence in a class of securities such as subprime, the values fall out of bed, the financial statements are worthless, and you're at what I suppose AIG considered the highly unlikely occurrences in their computer models. If there was a fault there, I think it was governance at AIG that didn't recognize the severity of the damage if the unlikely did occur, and there was no preparation for that. But each of these are unique situations. It's only the speed of the death spiral that is the same, and whatever legislation arises out of this, it's very hard to script the steps that should be taken. I think you'll find that the most important thing is to have the risks fully understood in advance so people are at least ready to deal with them when they do occur, and each one is unique. Anyway, having advanced the $85 billion facility on September 15, the maiden lane 2 and 3 deals didn't occur for several months later. Meanwhile, the Fed had a lien on everything of value. AIG had over 30 million customers, which were 30 million creditors, and the creditors from which it really wanted concessions and the notion of fairness are the creditors who were trading in the businesses creating the harm, primarily the credit default swaps and perhaps the securities lending. Those came down to the bulk of the exposure being with 8 counterparties, the vast bulk being with 16, according to other testimony I've read, including from Mr. Baxter in his a few months ago. So the bottom line is there were months to talk to the parties having the most exposure about what concessions they might grant if the government and AIG would basically in partnership take them out. Now, what we know on the opposite end is the government took the worst case. They already held $35 billion of security, and the government paid the full value, the par value remaining. You can't do any worse than was done here. Hopefully, the government will be able to recover much and all of that. Apparently, it's oversecured from what I've read in Mr. Milstein's testimony that you'll hear later today. It's currently oversecured. But at the time, we have to recognize that the tables changed, and the essential message I want to give you is this is a process. You don't look at just the end games. Once the loan was made, once AIG was secured, 30 million customers were current, as well as its other creditors. AIG wasn't going to file bankruptcy voluntarily, and under those circumstances, no one could really file involuntarily because AIG was generally paying its debts as they matured.
Thank you, Mr. Bienenstock. I'm going to stop you there, but that's very helpful. Thank you. Mr. Clark, I just want to say again how much I appreciate your being here and Standard & Poor's stepping forward to give us some insight into the credit rating process here. If you could give us your opening remarks.
Yes, thank you.
Thank you.
Thank you, Chairwoman Warren, members of the panel, good morning. My name is Rodney Clark, and I serve as a Managing Director in Standard & Poor's Rating Services. And from 2005 through 2008, I served as S&P's lead ratings analyst covering AIG. I'm pleased to appear before you this morning. At the outset, I'd like to take a moment to speak generally about our ratings process and to explain what ratings are and are not intended to convey. S&P's credit ratings are our current opinions on future credit risk of an entity or a debt obligation. They express our opinion about capacity and willingness of an entity to meet all contractual and financial obligations as they come due. S&P forms its rating opinions through quantitative and qualitative analyses performed by our rating analysts, and after an opinion is formed, S&P publishes the opinion in real time and for free on our website, and we generally publish a more detailed narrative about our opinion. This is the process by which S&P arrived at its ratings on AIG. My written submission includes a table listing our global ratings history on AIG since 1990 and a more detailed description of our rationale for our rating changes. By way of overview, up to 2005, S&P's rating on AIG was AAA, our highest rating, reflecting our view that AIG's capacity to meet its financial commitments was extremely strong. Our opinion began to change starting in March of 2005. And S&P has since lowered its ratings on the company 4 times. In February 2008, S&P announced a negative outlook for the company's rating based on the way AIG was determining the fair value of its credit default swaps that it had entered into. AIG CDS guaranteed an array of structured finance securities, including securities backed by subprime residential mortgages. In May 2008, we lowered our rating on AIG further to AA- in reaction to the company's announcement of losses, including $5.9 billion related to its CDS portfolio, and we maintained a negative outlook on AIG's rating throughout the summer of 2008. In August, S&P announced its view that AIG's actual credit-related losses in the CDS area would likely amount to $8 billion with significantly higher mark-to-market losses. But the market value of AIG's investments and the investments of third parties that had purchased CDS guarantees deteriorated sharply amid the substantial market turbulence in September 2008. In light of these events, on September 12, 2008, S&P placed its ratings on AIG and all AIG subsidiaries on credit watch with negative implications. On September 15th, as AIG's condition continued to deteriorate, S&P lowered its rating further to A- in light of increasing CDS-related losses and its reduced flexibility in meeting the collateral needs. In our view, were it not for the extension of an $85 billion borrowing facility by the Federal Reserve Bank of New York on September 17, 2008, AIG's creditworthiness would have continued to deteriorate. Our current rating on AIG, which remains A-, includes a 5-notch uplift to account for federal government support. Our current view is that AIG has made significant progress in reestablishing its insurance market presence and in implementing a very challenging restructuring plan. However, we believe AIG remains susceptible to competitive pressures as well as aggressive market pricing. With respect to the effect of AIG's current financial situation on the creditworthiness of its subsidiaries, we believe those subsidiaries are to some extent insulated by the state insurance laws and regulation. For example, if AIG had been forced into bankruptcy, the bankruptcy would have likely included a relatively small number of AIG's non-insurance subsidiaries, such as AIG Financial Products, with only a marginal impact on AIG's insurance subsidiaries. Nevertheless, when S&P lowered its credit rating on AIG to A- on September 15th, we also lowered the ratings on most of the insurance subsidiaries to A+, where they remain today. While AIG's financial problems have no direct effect on the solvency of the insurance subsidiaries, we believe the creditworthiness of those subsidiaries is nevertheless indirectly affected by the decreased likelihood that they could receive additional capital from AIG, as well as the reputational risk resulting from the parent company's financial problems and its impact on customers. You've asked me to explain S&P's ratings treatment of certain distressed exchanges. Our criteria call for consideration of various factors in assessing whether a distressed exchange would be viewed as a selective default, including whether default, insolvency, or bankruptcy in the near or medium term would be likely without the exchange offer.
Just to, we just do one sentence. We've all read the report,
Okay,
but we're at 5 minutes now.
The important line then is every situation is different, and any significant discount to the payment of the obligations other than perhaps the time value of money could potentially constitute a default under our published criteria. Thank you for the opportunity to participate.
That was impressive. Thank you, Mr. Clark, to be able to take those last pages and put together in a sentence.
I knew the important line.
That's right. Mr. Moriarty, could you give us your opening remarks, please, sir?
Sure, we're pleased to. Thank you, Chair Warren, and other members of the Congressional Oversight Panel for the opportunity to present any information the New York Insurance Department can assist in fulfilling your important charge. There are some broad points I'd like to make. Number one, AIG Financial Holding Company is not regulated by state insurance regulators. The state insurance regulators are charged with regulating the insurance operating entities here in the United States. In that realm, our job is to make sure that policyholders are treated fairly and that the insurance that they purchase to protect themselves will be paid by the insurance company when legitimate claims are put on the table. Number two, the AIG crisis was a primary result of the credit default swaps issued by an entity that was, for all intents and purposes, in unregulated derivative shops that traded on the rating of AIG as a whole. During the crisis, the Fed's main concern was not the collapse of the insurance companies, which we don't believe would have happened, but AIG Financial Products had CDSs, had futures, had other derivatives with many of the major commercial banks and brokerage firms. The failure to perform on these transactions would have a systemic impact on the worldwide economy, especially since the counterparties to AIG Financial Products were already reeling from the failure of Lehman, the problems with Bear Stearns, and the extreme stress at the other financial institutions. The aggressiveness of AIG's bullish outlook on the residential mortgage market did bleed into the insurance companies in the form of the securities lending. When the size of the securities lending program in the life insurance companies became known to the insurance companies in terms of its size, which was probably in the beginning of 2007, we, with other states, worked with AIG to begin to wind down that securities lending in an orderly fashion, and it did go from a high of $76 million in the beginning of 2007 down to $58 billion right before the implosion of AIG in September of 2008. The crisis was caused the crisis caused by financial products did spook the borrowers of the securities lending program, and they would not let the borrowings roll over as they had done in the past, and instead required that the AIG return the cash collateral that was provided for them. AIG had invested a lot of that cash collateral in residential mortgage-backed securities, which were underwater and fairly illiquid and would have taken a significant loss at the life insurance companies if those collateral calls were made. Once the $85 billion federal facility was established by the Fed, AIG did take advantage of that and used some of it, $17 billion worth, to pay back some of the borrowers of the securities. But the remainder of the sec lending portfolio remained kind of an albatross around AIG as a going concern. Main Lane 2 was formed in December 2008 to effectively end the sec lending program at the AIG life insurance companies. Now, for the $19.2 billion that was provided by the federal government for approximately $39 billion in par value residential mortgage-backed securities. Again, they are being paid back, and by all indications, they could make a profit on it. I think it's important to remember that credit default swaps and security lendings are different transactions. In a securities lending program, the borrower posts collateral. If you do not return that collateral, they will keep the securities that they borrow. So AIG was going to suffer a loss on the sec lending programs, and it's a different transaction than a credit default swap. Quickly, in response to our oversight of the AIG insurance companies, as all states do, we review insurance financial statements and other ancillary documents that are furnished by our domestic insurance companies. We do on-site management examinations and regular meetings with management. At the time of the crisis, AIG had 71 licensed insurance companies in the United States. 7 of those were domestic property casualty insurance companies, and 3 of those were life insurance companies. On Friday, we did get the call from the CFO of AIG that a downgrade was imminent and it would have drastic ramifications. A team of New York Insurance Department high-level representatives were sent to the AIG office. It was during that weekend that the proposal to allow the property and casualty insurers to effectively swap $20 billion of liquid assets with some of the residential mortgage-backed securities were put on the table. I just think it's important to note that there were conditions to this, and that was that there was capital provided by outside investors, and that the life insurance companies be put underneath the P&C companies, effectively becoming subsidiaries of the P&C companies.
Very helpful. Thank you, Mr. Moriarty. So I want to be clear, if I can, about setting the stage a little bit for this panel. If you've read the testimony from the Fed, and we've had multiple meetings now with the Fed, they basically have made the argument that negotiation was simply not possible, and that it was not possible because it's not possible, because negotiation under these circumstances, particularly in a case of rapid descent, is never possible, that ratings downgrades would have triggered multiple cross defaults and contagion throughout the market, and that the insurance regulators would have seized the insurance companies and therefore destroyed the value of the entity and possibly caused losses to the insured people around the country. So the reason we asked this panel to come is that we wanted to probe that claim. That's what we're here about, is to just push back on this alternative. So I at least am going to start that. I want to start that, if I can, with you, Mr. Clark. Following the bailout of 100 cents on the dollar, because the Fed has described, and they describe in their written testimony, it was totally binary. It was either a full bailout with full payment to everyone, or it was no help, bankruptcy, and collapse, as they saw the alternatives. And so what I want to ask here is, following the Fed bailout, there was still a ratings downgrade, right? I think I'm reading you have some slight readjustment. No?
You're saying following
the actual bailout.
The $85 billion, the initial.
That's right.
Okay.
Right. You have some change in how you're rating AIG?
Yes, on September the 17th, following the change, we had lowered the rating on the Monday, the 15th, to A-. On the Wednesday, we maintained the rating at A-. We revised the credit watch, which indicates the direction of possible movement, from negative, because the trend was clearly negative on Monday, to developing on Wednesday. That implying could go up or down, but we were still sorting out the impact of this facility.
So government help, you had to evaluate it, evaluate what its impact was going to be, its size, the likelihood it would be there in the future. And I would assume from the ratings you gave, it was not guaranteed that it would be there forever. Otherwise, it would have gone back up to AAA.
Correct.
So you were trying to evaluate that. And as we all know, AIG ultimately paid every creditor 100 cents on the dollar and has continued to do so to this day. So here's my question. I also read in your testimony that right now AIG gets a 5-notch improvement because of your assessment of the value of the government assistance. If AIG had had a negotiated settlement of some kind with government assistance, with private assistance, and with a haircut to the creditors of some dollar amount, would they have been better off than if they had paid 100 cents on the dollar, or would they have been worse off going forward into the future? What would have been their financial picture? If you can pay less on your debt, are you better off than if you pay 100 cents on the dollar on your debt?
Right, and it's difficult for me to explain in the hypothetical, but I know in our ratings criteria on distressed exchanges, which we shared with the panel staff previously, it speaks to the fact that we would consider a distressed payment of less than what is owed to be a default or a selective default under our ratings criteria. However, it is true that in many cases, following a restructuring, following either a distressed exchange or a series of distressed exchanges, that the credit condition could be better than before the time of the exchange.
Okay, good. That was the part I needed. And then if one combined this distressed negotiation with substantial funding from some combination of private and public sources, what would the credit rating look like going forward?
I can't speak to the hypothetical without knowing the terms, but it is possible that it could have been similar, better, or worse.
Okay, so I'll ask it then just the other way, and then I'm through. And that is, was it a foregone conclusion that their ratings would be completely wiped out if they paid something less than 100 cents on the dollar, if they had secured both government and private money going forward?
Under the criteria that we use, we look to, was the counterparty paid what they were owed, and was it done in a distressed situation, that is, to save the company from insolvency or bankruptcy? If there were a modest discount, such as relative to interest rates and the time value of money, that would not have necessarily caused a default. But those are factors the rating committee would weigh in determining, is the exchange distressed or isn't it, and determining what the impact on the ratings would be.
Okay, along with how much money is available going forward.
Absolutely.
Right? All right, good. That's helpful. Thank you very much. Mr. McWaters?
Thank you. Let me follow up on that, Mr. Clark. If there's a distressed exchange at the same time the government has made commitments, I mean, has by this time, by November of 2008, put in so much money that it seems unlikely the government is going to walk away from that. So at that point in time, it's not that AIG needs to do these distressed situations in order to save money for liquidity, because it has Uncle Sam providing the liquidity. It's in effect doing the distressed transaction in order to treat the taxpayers more fairly. I mean, does that resonate with you at all?
I believe so. I'm not sure I'm hearing the question.
Well, the question is yeah, we're going to cut a deal. We're going to cut a haircut. But the reason we're cutting a haircut is not to save money for liquidity of AIG, because that's been assured by the taxpayers, by the Federal Reserve Bank, already putting in $85 billion. Unlikely they're going to walk away. We're going to cut a haircut because that's fair to the taxpayers. Because the taxpayers are putting in the money to take these guys out.
Okay, now, understand the basis for our ratings. We've published a view that the rating, absent the federal support on AIG today, would be BB. And suffice it to say, a year ago, it would have been worse than that. However, it's an A- rating with the benefit of the government support. That is based on a view that the support that exists is available to allow the company to meet its financial obligations. So it is fair to say that our rating committee would look at a situation where AIG has significant funding but isn't able to use it to satisfy its financial obligations in whole, be it for the credit default swaps or other obligations. We would have to form an opinion, well, will that funding be available to future financial obligations to pay them on time and in whole? And so those are all factors that we'd have to evaluate in determining the appropriate rating. As it's been to date, the credit facility has been there for essentially all of the financial obligations as needed. If that were not the case, we'd reevaluate the value of the support in the rating.
Okay, so this is not a simple situation that if there is one of these distress exchanges, therefore the wall falls down. Okay. Mr. Bienstock, I read your testimony with great interest. You seem to present an elegant alternative to what happened, and I think you were about to get into that in your opening remarks. Would you care to elaborate?
Sure. Once the government came forward with the $85 billion facility and secured it with everything of value as far as I can tell, the dynamics changed. Bankruptcy was now off the table. Everything I've read in the public record so far has been the Fed, et cetera, didn't want to threaten a bluff about bankruptcy. But now the strength of AIG was to say, we're not voluntarily filing, and you can't involuntarily file because we have over 30 million creditors and we're paying 99.999% of them on time in full. So what is the remedy now of those creditors you think, who as a matter of equity to the taxpayers, should provide a discount? The remedy is not a lot. They can go at most to state court at the cost of great public notoriety. Some of these entities had government assistance separately. Other of these entities, for instance, purchased Lehman Brothers for $250 million plus the appraised value of the real estate it received, and then had to acknowledge in its SEC filing a $3.5 billion profit on the purchase. I'm saying, as a matter of common sense, I don't think these entities were in a position to say to the U.S. government, no, we won't make some moderate but meaningful concession in exchange for taking us out entirely of these credit default swaps. Remember, that's what was done. They were paid 100 cents. So, and we could always go, or AIG could always go to the rating agency and say, look, we're only asking for concessions from businesses we're winding down. We're not doing more of this foolishness. And as far as all our insurance companies, all ongoing businesses, we have the facility there. It's available for payment in full on time.
Okay, thank you.
Mr. Silvers?
Mr. Bienstock, your response just then, when in your view, I mean, this, let me first get straight, this is your profession, is it not, giving advice in these types of situations, these highly pressurized insolvency crises?
Yes, Mr. Silvers.
Right. When are you suggesting that the approach that you just outlined would have best been deployed by the Federal Reserve?
Once they, after, the first thing was to stabilize, to provide the $85 billion facility. Then in discussions with those people who should equitably give concessions over the next several weeks, months, they took until November and December to close their deals, so they had plenty of time to do this.
So, but essentially, you're saying as soon as it had been made clear to the markets, in general around the systemic risk issues and the like, that a simple Chapter 11 filing was not happening.
Well, yeah, to give you a bit more of a professional response, and you said this is my profession.
Right.
What I would say to the client is, after you've taken care of your lifelines, now who were AIG's lifelines? First, speak to Mr. Clark to explain exactly what's going on, why this will improve creditworthiness going forward and not endanger others. After explaining to employees, customers, et cetera, here's how we're going forward. Then once you've got your lifelines intact, once the government, which is the revolving credit facility lender, knows what you're doing, now's the time to do it.
Mr. Moriarty.
Yes.
It has been represented to us, and I think you heard some of it this morning, that absent what the Fed did and precisely the way it did it, there would have been a crisis for the insurance subsidiaries and their ability to maintain their business, pay their obligations, and the like. A crisis that so serious that it was absolutely necessary to rescue the parent in the manner the parent was rescued in order to avoid such an outcome. I think there is a kind of implicit analysis made by the Federal Reserve and the Treasury in saying so, that whatever problems might have arisen in the insured subsidiaries, that would have been beyond the ability of the state insurance regulation and guarantee system to manage. What is your response to both those propositions, and specifically, what was the view of the New York State insurance regulators and I forget the term of art now, but there's a sort of coordinating body of state insurance regulators. What was your view during the so-called Lehman weekend around these questions?
Sure. I'd like to bifurcate my answer into two parts. We do not believe that the existing policyholders of the AIG property and casualty companies, for sure, or even the life insurance companies would have suffered any losses would there have been a bankruptcy of the AIG holding company system. State insurance law through the McCarran-Ferguson Act clearly gives the states the authority to regulate insurance companies and to rehabilitate and liquidate them, which is a different process from a bankruptcy. So we would maintain that the existing policyholders would have been made whole even if there was a bankruptcy. The life insurance subsidiaries would have suffered significant losses, and the cushion, which we call surplus, which is effectively capital between assets and liabilities, would have taken a severe hit, but we still think it would have been positive. Now, when we look at AIG as a going concern, that would have been a problem. Clearly, the reputational risk of a bankruptcy at the holding company level could shake the confidence of the policyholders on the property and casualty side. Much of the business is placed by three big brokers. If they had blacklisted AIG for all intents and purposes as a going concern, that they would be gone. Same on the life insurance side. So to the extent that there was a bankruptcy, there would be a concern as to the ability of the AIG companies, insurance companies, to proceed as a going concern. Now, that being said, there are options. There could be sales of the book of business to existing insurance companies. There could be transfers of certain parts of the books to other companies. So, I mean, there could have been some money moved around. There could have been rebranding. I mean, it's hard to speculate. But clearly the bankruptcy would have had a troublesome impact on it.
I'm not asking you to speculate, but just to remember, did you all communicate a view that, did your department, or did, to your knowledge, other insurance regulators communicate a view to the Federal Reserve or to the Treasury during this period that the parent of AIG had to be rescued in the manner that it was rescued?
No, he didn't.
Did you communicate any view at all to the Fed, the New York Fed or the Treasury?
When we were at the Fed beginning Saturday morning, I think it's clear from the Governor Patterson's offer, New York and Pennsylvania at the time, which were the two lead regulators of the property and casualty companies, did see an opportunity to basically lend AIG FP $20 billion in more marketable securities, and we would take over the less liquid residential mortgage-backed securities. We did that, again, on the premise that, number one, that there would be new capital provided in AIG Inc. by outside investors, and number two, that the life insurance subsidiaries, and thus the value of the life insurance subsidiaries, would be put underneath the P&C company. So we were looking for I guess you call it a private savings, but it had to be a global solution. It had to be part of a solution that would allow AIG to continue making its way through the financial crisis. Anything short of that, I think we'd be highly reluctant to let any money come out of the property and casualty insurance companies.
Okay. Thank you. Professor Trotsky?
Thank you. I guess maybe I'll start with you, Mr. Bienstock, and you can help, because one of the things I haven't understood about AIG in particular is the claim that seems to be made that had AIG entered bankruptcy, they would have simply ceased operating, which seems somewhat different than most companies that actually do enter bankruptcy. If the recent experience of Chrysler and General Motors and a variety of airlines is any example, companies often do enter bankruptcy and workers get up the next morning, go to work, and continue to produce products. Do you have any sense of what's different about an insurance AIG in this instance and Chrysler or General Motors or United Airlines, who have all or?
Yeah, I think so. The clear distinction is that trading operations can only trade when there's confidence in the marketplace. That's why Enron's trading ceased before it filed its Chapter 11 petition. That's why AIG's would also. Additionally, there's.
When you say trading, you mean their securities trading, not their insurance business?
No. I'll get to that.
Okay.
The insurance companies are subsidiaries that are ineligible to go into bankruptcy.
Right.
They could be seized by state regulators or not, but they would not technically be in bankruptcy themselves. They might be in state proceedings. But at the holding company, the various non-insurance operations, the bankruptcy code has special provisions for derivatives trading that allows counterparties to terminate and to liquidate. That's the thing that doesn't operate. The rest of the operations that are, if there are any, more like the airlines, the auto companies, they can continue. I don't think AIG had many that type of operation.
Okay. And Mr. Moore, you made the claim, and this is the claim that's often made, and it was a claim that was made auto companies of why they shouldn't enter bankruptcy, because the warranties, all of a sudden, who's going to buy a car from a bankrupt car company, because, you got no guarantee that that you could, that they were going to be around to protect the warranty. Of course, the warranties can also often be provided by third-party people and do it all the time. And so, again, when I look at it as an economist, if there's value being produced, somebody's going to produce that value because they want to make a profit in a market-based economy. So if AIG had valuable entities, even going into part of the company went bankrupt, somebody's got to be able to step up and continue to provide the services they do, albeit maybe under a different name. Does that seem like a reasonable outcome?
I think it is. Again, there are reasons that the state insurance laws wall off the assets and the liabilities of the insurance entities from all of the non-insurance entities, simply because the assets are meant to pay the policyholder claims. AIG, as one of the former panelists indicated, employed over 100,000 people worldwide. There were less than 500 people employed by AIGFP, which arguably brought down or caused severe stress to AIG. AIG clearly had a lot of talent in terms of its core businesses, which was property and casualty insurance and life insurance. And those subsidiaries could have been sold. The business could have been taken by other entities. I think there were options. I think the policyholders, number one, would have been paid, and number two, probably could have gotten new coverage, whether from a company that was sold by AIG or a commercial account that just went to AIG. I do think that two of the concerns that we were most concerned about with respect to AIG was, number one, that they would lose customers because of the reputational risk, and that they would lose good people because of the reputational risk. Those are concerns that are still remain with us.
But that's no different than any business. I mean, presumably, do you want to fly on an airline that's bankrupt? I mean, when I get on an airplane, I sort of do depend on the person driving it. And if I'm, that I got to think that those concerns are maybe even more paramount. I think I'm more concerned when I get on an airline than about my life insurance policy.
Well, again, an insurance, it is a promise to pay.
It is, yes.
It don't make widgets, and it doesn't make cars.
Well, an airline is a promise to get you there alive.
Yes,
so,
correct, correct.
Okay.
But I understand your point, and I do agree with you.
And so let me, one more question. Mr. Clark. So we've discussed today about the combination of a private sector, public sector, financial support for AIG. How would that have affected, had the federal government put in less money, private sector put in more? Can you speculate a little? Would that have affected the ultimate rating of AIG in your mind?
No, we'd be looking to the outcome in terms of AIG's sources of liquidity, its ability and willingness to meet its obligations when due, whether that funding was private, public, or a mixture. That wouldn't have affected our rating.
Okay, thank you.
Thank you. Good. Thank you. Mr. Bienenstock, I think you were in the room to hear Mr. Baxter explain the role of the Fed in the long-term capital management negotiations. And I think his words were that the Fed explained to the creditors what was in their own best interests in reworking what needed to be done. Can you talk about what kind of conversation might have occurred with the counterparties to AIG and what was in their own best economic interest? I think you hit this, but I just want to make sure we got this one nailed down.
I'm sensitive to the concern of the Fed not to use its regulatory power in a debtor-creditor capacity where they're serving as a lender. So I'll phrase it as to what any 800-pound gorilla lender, such as one of the big banks, or in this case the Fed, would have said to the other creditors. And the answer is, we're taking a lien on everything. In this case, it's unique, as I said, because bankruptcy was taken off the table for other reasons. We're taking a lien on everything. Bankruptcy is not an option. We're willing to do a transaction with you if you make a fair concession for the benefit of all taxpayers, because if not for our money, you would have taken a big loss on us for the most part. And what are your options? Your options are to do nothing, in which case we won't do a transaction, you won't have more money from us, we won't buy out your CDO. Your options are to go to state court. We'll argue a while about whether you're entitled to more collateral and how much more, and by that time the underlying dynamics will have changed. But at the end of the day, you're not going to have a remedy that really gets you value, because we're sitting here with an $85 billion lien, and you'll be in the newspaper and on the news every night trying to frustrate the United States government's effort to save the global financial system. Now, what would you like to do?
Okay, I think we have that. Can I ask you one other that comes out of your testimony or your written testimony, and that is you talk about shared pain, the principle of shared pain in bankruptcy. Can you just elaborate a bit on that?
Sure. We all grow up being told that when we make a promise, we keep it. When we give our word, we keep it. And one of the things that makes bankruptcy counterintuitive and, frankly, offensive to a lot of laypersons is that in bankruptcy, if a debtor breaks one promise, takes one creditor and doesn't pay it, but pays its others, that's pretty unfair. So the more fair procedure is to break all its promises and to share the pain equally across all the creditors. That's where bankruptcy is contrary to most of our notions of substantial justice. So sharing the pain is the way of the creditor being hurt or the lender coming up with innocent taxpayer money saying, it's unfair that we're taking all the pain. You're getting paid 100 cents for a business that couldn't have paid it if we had not come to the rescue. You have to share equally because that's fair.
Okay, thank you very much, Mr. Bienenstock. I'm through. Mr. McWaters?
Thank you. Mr. Bienenstock, when I was reading your written submission, again, I was struck by the elegance of it, rather the simplicity of it, and which made me think, well, why wasn't this done? Why didn't other people think of this? Then I got to page 4. And you say on page 4, you say, additionally, the Federal Reserve Bank of New York retained an outstanding law firm and attorney for its work. But the law firm is identified with representing Wall Street institutions such as J.P. Morgan, and it would be awkward for it to devise strategies to obtain concessions from those institutions. Could you help me understand that?
Sure. In this case, I think it sounds to me, because of the exigencies of time, the law firm that was probably familiar with the situation, other than AIG's own law firms, was the law firm being used by J.P. Morgan and Goldman Sachs to try to come up with a private solution, which I heard earlier, I think, was a Monday, September 15 effort.
Yes.
So since they had immersed themselves in the documents, I suppose at least that was one factor why, with waivers granted and full disclosure and all the rest, this was all done properly, I'm sure, that J.P. Morgan and Goldman Sachs surrendered their counsel effectively to the Federal Reserve Bank of New York. Those counsel they are outstanding, as I said, both as a firm and the individual who was leading it. But they are known to represent the Wall Street interests. Not that they don't represent others, but they're synonymous in the restructuring industry with representing the Wall Street interests. So it would be awkward, as I said, for them to concentrate on, well, here's how we might get concessions from counterparties who are their clients in many other matters.
Well, I assume this is particularly true given that 2 weeks from now they'll be back representing J.P. Morgan, and J.P. Morgan may say, yeah, you're the guy that just came and represented the Fed and came to us and beat us up for a concession.
Well, and I want to emphasize, this was done, and I think the Federal Reserve Bank of New York people said earlier, this was done with full waivers, et cetera. It was done totally properly. It's allowed to be done, and it's often done. In this case, I just think it put counsel in an awkward position. And also, you've heard, there are a lot of explanations. I mean, not everyone gives my analysis, certainly. Maybe no one did. And there were a lot of explanations that were facile for people to latch onto why you should just pay all the creditors all the time.
Correct. One last question. If on September the 16th, I came to you and retained you and said, we've just given this entity $85 billion, this entity, AIG, $85 billion, and it's on 180 days, is a bridge. Can you work out a prepackaged bankruptcy of AIG, working with the insurance companies, the rating agencies, and the like, within 180 days and reach resolution?
I would have told you less than a 10% likelihood. And let me just amend something I said before. I did, before today, test with restructuring experts, both business and legal, the idea of getting concessions, and I was surprised to find I got unanimous buy-in to that. On the pre-pack, the reason I'm saying less than a 10% likelihood is, as a matter of right, any creditor can ask for an examiner. God knows there was a lot to examine here. I think that's what you're doing. That can take months or years. I would caution you that if you're doing the bankruptcy after the $85 billion revolver has been extended, that $85 billion is subject to restructuring and bankruptcy like all the other debts.
Sure.
Prepackaged is a term used most technically for making a deal with everyone in advance, going to court and asking for swift approval of the plan. It basically works when you have a small group of sophisticated parties or you're just paying everyone in full. Here, if the decision had been made to pay everyone in full, then my answer of less than a 10% probability would change. I would say if you're going to pay everyone in full in that pre-pack, then yes, you can, more likely than not, you can do it in 180 days. But if you're not paying everyone in full, I would say the likelihood of dealing with millions of people who have guarantees for their insurance policy, thousands of other types of creditors, including derivative creditors, in 6 months, it's nearly impossible.
Okay, well, thank you. And that helps support your solution that you have in your paper. Thanks.
Thank you. Mr. Silvers?
Mr. Clark, you, like Mr. Moriarty, have been assigned responsibility by our national government for much of what has happened here. By you, I mean your firm and the other credit rating agencies. I want to, offer you the opportunity to, if you dispute what's been said about the rating agencies by our other witnesses, to do so. But I want to also ask you a very specific question about a different way of thinking about the options available, which is, if rather than rescuing the parent, right, the Federal Reserve had chosen to make 13.3 lending available to subsidiaries, right, on an as-needed basis, would it have been possible to have maintained the same level of credit rating by your agency and others that was effectuated by rescuing the parent? And just to make this question a little bit more complicated, do you agree with Mr. Moriarty's assessment that the subs could have handled their problems around securities lending absent the problems of the over-the-counter derivative business at the parent level?
That's complicated.
That's complicated. Well, three distinct questions. One open-ended. The second question is, could you have maintained the creditworthiness of the subs directly and let the parent go, or have the parent go through something like perhaps what Mr. Bienenstock was talking about? And thirdly, is Mr. Moriarty right that the subs could have handled the securities lending problems without further assistance?
Okay. I'm going to leave the open-ended one on the table. But if the New York Fed had lent directly to the subsidiaries, I don't know that they had the authority to do that, and I can't really speak to whether that would have helped the subsidiaries to maintain the credit ratings without understanding what the terms would have been.
Well, let's just assume that we're talking about essentially what happened to the parent, a blank check under 13.3, and you can lend to anybody under 13.3. I think that's kind of what we've learned. But let's just, I don't want a legal opinion about whether the Fed had the authority. Let's just assume the Fed opened the spigot to the subs. Could they have opened the spigot wide enough to maintain the credit rating of the subs?
I presume that they could have. It's much, much more complicated when you look at the fact that by lending to AIG, there's sort of your filter to get money down to the subs. But when you talk,
but they're a filter with a giant hole in it called credit default swap.
Well, of course, understood. But that was only one of the places that those funds coming from the New York Fed were going. And when you look at the literally hundreds, when you start looking globally, of regulated and unregulated subsidiaries of AIG, I think it would have been very difficult to get money to all of those. In addition, you had cross guarantees between certain of the subsidiaries, both domestic and foreign, which most often went back to insurance companies regulated in New York or Pennsylvania, not always. It was a very complicated web of relationships, really just necessitated by the complex global nature of the group.
So it's much simpler to do it at the parent.
It was much simpler to do it at the parent.
But you're not saying that you couldn't have done it.
I don't know that under their authority they could or could not.
No, I'm not talking.
It would have complicated the task.
Right, would have complicated the task. Okay. Do you agree with Mr. Moriarty that the resources were available at the subs to deal with the securities lending problem?
I think it's possible that they could have. I do think, though, if you look at what happened between September 15th and really the end of the year, when the enormity of the financial crisis, the continued investment losses, not only on the securities lending program, but on other investment holdings of AIG's insurance companies and many other insurance companies in the industry, there was a drain there, and AIG, through its resources from the New York Fed, did inject significant capital into the domestic life insurance companies. Could they, without the drain of the CDS, have handled that themselves, given the continued decline of the financial markets? Possibly, but it's difficult to say with any certainty.
One more question. Is it possible, in your opinion, for a major insurance player company to operate with a double B credit rating?
It depends on the businesses that they're in.
Assuming they're diverse, assuming maybe
Right.
Mr. Moriarty has a view. I mean, assuming a diversified range of businesses, life and P&C,
It's possible.
and investments.
It's possible, and we see it in certain areas. Certain areas of insurance are more confidence sensitive than others. When you look at some of AIG's businesses that were in high net worth life insurance and annuities, those are very confidence sensitive, vulnerable to run on the bank in a severe stress. And the large commercial insurance, similarly, not a run on the bank risk, but very sophisticated purchasers of insurance who value credit and would be unlikely to purchase or renew business.
Double B is below the line, isn't it?
Yeah, definitely. Or in most buyers' views, it would be.
Mr. Moriarty, I couldn't tell whether you were agreeing or disagreeing.
No, I disagree with my colleague. Again, the commercial side of the business, whether it be on the property side or the high worth net individual, very rating sensitive, and do due diligence in terms of the creditworthiness of the insurance companies that they're dealing with. For some personal lines like auto and homeowners, arguably they can write at the lower levels. But something below investment grade even would be difficult to write any extensive book of business.
I have one more question.
Quick.
Quick. Mr. Bienenstock, can you help us understand, from your general knowledge of these markets and so forth, J.P. Morgan Chase and AIG, was there mutual dependency here of some kind during this period?
Gee, I'm not.
Do you have any insight into this?
I'm not familiar with their contractual relationships.
Okay, thank you.
Thank you. Dr. Trotsky.
Thank you. Mr. Moriarty, I guess I'm going to ask a general insurance question, and I'm going to try to put it in as simple terms as possible because I think sometimes we get a little confused by the jargon. AIG was writing credit default swaps, where essentially they were insuring mortgage-backed securities.
Out of AIG financial products, yes.
Some of them. While simultaneously the company was also purchasing mortgage-backed securities.
Correct.
So they were actually purchasing products that they were also insuring.
Doubling down, yes.
Yes. I'm no financial expert, nor am I an expert in insurance. That seems rather odd to me, that a company would both insure something and then expose themselves even further to the risk that they're insuring. Is it usual for insurance companies to double down in this fashion?
No, it's not, actually. You usually try and make sure that the risk on the asset and the liability side don't have a high degree of correlation. When we first looked at the SEC lending program, it was uncovered by Texas, which has one of the biggest life insurance companies, and they were doing an examination, and they just noted that this thing was growing exponentially, and alerted other states. At the time, AIG management had come in to the regulators to explain the program, and we expressed concern about two things. Number one was the size, and number one was the fact that they were investing the cash in securities that were longer dated than the liabilities on the securities lending. So they depended on the counterparties to effectively roll over, or else they'd have to liquidate the securities. Then we went into the diversity of these securities, which were 60% over 60% in residential mortgage-backed securities, which was clearly a high amount. But they brought up the point, these were all AAA rated, they were all AA rated residential mortgage-backed securities that were in fact diversified because they came from different originators. The collateral was spaced throughout the country, basically the mortgages, and there hasn't been a meltdown of the residential mortgage across the country in the United States in a long time.
15 years.
And so, again, from their viewpoint, it was an imprudent activity and gave them more investment yield. But nonetheless, the sheer size of it and the concentration in the RMBS, that they did at our behest begin a significant downsizing of it without reporting big losses, and they reduced it by 24% in a year, from $76 billion down to $58 billion. And we do things that, again, absent the the issues at FP and the financial crisis, that the sec lending program would have been wound down.
Let me make or ask another question too. It's actually when you're doing this, when you're sort of both insuring and purchasing, you exacerbate the risk because now you've got what's known as a covariance, the way the two of them move together. Because typically you only have to worry about how the changes, the potential changes in one. So it's actually very important if you're doing both to understand how the things you're purchasing are going to vary with the things that you're insuring.
No, I totally agree with you, Doctor.
Okay.
I think one of the issues, though, is that we regulate the insurance company. We
Right.
do not regulate
I'm asking you as just as an insurance expert, not as that you should have been overseeing this, because I don't want to imply that. So let me, and Mr. Clark, so as Mr. Mori already indicated, that these were all triple-rated securities or double-rated. But when you take, and again, I'm going to be real simple here, and this is not particularly what you've come to talk to us about, but when they were coming to you with essentially a box of mortgages, and S&P was giving a rating on those mortgages, you were rating the mortgages in a box, and then selling, and then the bank would go out and sell them to somebody. But what AIG now had is they were insuring a box over here, and they were buying a box over here. And you're not evaluating how those two boxes are going to move together, which is a key point for AIG. If they're both insuring and buying, that you're not evaluating the covariance between those two investments, are you? Well, your AAA just tells me about the likelihood of loss from these mortgages I own, not.
Let me separate out what I can and can't answer. First
Okay.
of all, I'm an analyst in our insurance
Right.
ratings practice responsible for AIG,
Okay.
so I can't speak to how the ratings were arrived at in structured finance.
Fine.
I can speak to the analysis we did on AIG's securities lending and its
Okay, that would be great.
its CDS portfolios, and we were throughout 2008 analyzing those portfolios and making projections, which we updated publicly to the market throughout the year as to our expectation of losses that the firm would likely see on those portfolios. Both. We were looking at both, and we were combining the analytics. What we saw, however, was that in the fall of 2008, and very much to Mr. Moriarty's point, that we'd seen housing declines before, but one on a nationwide scale of this depth of magnitude, that was really outside of our assumptions and the assumptions of many in the market. It was quite unprecedented. So we did find that the performance of both of those portfolios, although we modeled them together, looked at the exposure together, the eventual losses did exceed what our expectations were.
Good. Thank you very much. I want to thank all three panelists, Mr. Bienenstock, Mr. Clark, and Mr. Moriarty. We appreciate your taking the time to be here with us today. This has been very helpful to the panel and will be very helpful to our report. We're going to call a recess for this panel for half an hour. We'll start again at 1:45, and our first witness at that point will be Clifford Gallant. Thank you. Hearing is back in session. I want to welcome Mr. Gallant.
The trader, or there's a pervasive market shift in confidence in a class of securities such as subprime. The values fall out of bed, the financial statements are worthless, and you're at what I suppose AIG considered the highly unlikely occurrences in their computer models. If there was a fault there, I think it was governance at AIG that didn't recognize the severity of the damage if the unlikely did occur, and there was no preparation for that. But each of these are unique situations. It's only the speed of the death spiral that is the same, and whatever legislation arises out of this, it's very hard to script the steps that should be taken. I think you'll find that the most important thing is to have the risks fully understood in advance so people are at least ready to deal with them when they do occur, and each one is unique. Anyway, having advanced the $85 billion facility on September 15, the maiden lane 2 and 3 deals didn't occur for several months later. Meanwhile, the Fed had a lien on everything of value. AIG had over 30 million customers, which were 30 million creditors, and the creditors from which it really wanted concessions and the notion of fairness are the creditors who were trading in the businesses creating the harm, primarily the credit default swaps and perhaps the securities lending. Those came down to the bulk of the exposure being with 8 counterparties, the vast bulk being with 16, according to other testimony I've read, including from Mr. Baxter in his a few months ago. So the bottom line is there were months to talk to the parties having the most exposure about what concessions they might grant if the government and AIG would basically in partnership take them out. Now, what we know on the opposite end is the government took the worst case. They already held $35 billion of security, and the government paid the full value, the par value remaining. You can't do any worse than was done here. Hopefully, the government will be able to recover much and all of that. Apparently, it's oversecured from what I've read in Mr. Milstein's testimony that you'll hear later today. It's currently oversecured. But at the time, we have to recognize that the tables changed, and the essential message I want to give you is this is a process. You don't look at just the end games. Once the loan was made, once AIG was secured, 30 million customers were current, as well as its other creditors. AIG wasn't going to file bankruptcy voluntarily, and under those circumstances, no one could really file involuntarily because AIG was generally paying its debts as they matured.
Thank you, Mr. Bienenstock. I'm going to stop you there, but that's very helpful. Thank you. Mr. Clark, I just want to say again how much I appreciate your being here and Standard & Poor's stepping forward to give us some insight into the credit rating process here. If you could give us your opening remarks.
Yes, thank you.
Thank you.
Thank you, Chairwoman Warren, members of the panel, good morning. My name is Rodney Clark, and I serve as a Managing Director in Standard & Poor's Rating Services. And from 2005 through 2008, I served as S&P's lead ratings analyst covering AIG. I'm pleased to appear before you this morning. At the outset, I'd like to take a moment to speak generally about our ratings process and to explain what ratings are and are not intended to convey. S&P's credit ratings are our current opinions on future credit risk of an entity or a debt obligation. They express our opinion about capacity and willingness of an entity to meet all contractual and financial obligations as they come due. S&P forms its rating opinions through quantitative and qualitative analyses performed by our rating analysts, and after an opinion is formed, S&P publishes the opinion in real time and for free on our website, and we generally publish a more detailed narrative about our opinion. This is the process by which S&P arrived at its ratings on AIG. My written submission includes a table listing our global ratings history on AIG since 1990 and a more detailed description of our rationale for our rating changes. By way of overview, up to 2005, S&P's rating on AIG was AAA, our highest rating, reflecting our view that AIG's capacity to meet its financial commitments was extremely strong. Our opinion began to change starting in March of 2005, and S&P has since lowered its ratings on the
Gentlemen, I want to thank you all three for coming here today. We appreciate it. And I'm going to ask you if you would make opening statements, if you could hold your remarks to 5 minutes. As you can see, we are a lively panel with many questions and flights back late tonight. So I'm going to ask to hold your remarks to 5 minutes, but your entire written remark will be part of the record. Mr. Bienenstock, could I start with you, please?
Yes. Good morning, Chair Warren and panel members, Deputy Chair Silvers, Mr. McWater, and Dr. Trotsky. Thank you for the opportunity to testify today. Since I've heard several times that the testimony is automatically in the record, I thought, at least in part, I would try to supplement what I've written by crystallizing some of what I've heard this morning and tying it to the relevant portions of my written testimony. First, I have no issue with the emergency action taken by the Fed to provide the $85 billion facility on September 15, 2008. And you have more information than I do, but all I can say is from what I've been able to read from a layperson in the public, based on the speed of the meltdown and the exigencies of the situation on the heels of the unrescued Lehman bankruptcy and collapse, I don't know of any alternative, whether there could have been some money from the private sector. I'm not sure at the end of the day will even make a big difference because the $85 billion facility was all secured. So the secured part will be paid back. Hopefully it's oversecured and the government will get all its money back at a profit. But it was secured with everything AIG had of value as far as I can tell. Where I might take issue with some of what has gone before, both this morning and in prior hearings, is the notion that everything was set in stone on September 15. And let me backtrack for just a moment. The speed and suddenness of the need for the $85 billion facility, while I can tell it's surprising to many, including some in this room, is not surprising to those of us who have been through crises involving trading companies before. I met with Enron the Friday after Thanksgiving in 2001, and the next week it filed Chapter 11. When you're dealing with a trading company, financial statements and balance sheets changes the assets and liabilities. It also changes the risk profile. When the market loses confidence in either the